Welcome back to the Options Academy. In this presentation, we'll discuss the basic ideas behind buying options as a trading strategy. As always, to maximize your learning experience, you can refer to our written article which matches this presentation. Buying options. Many fortunes have been made by options buying and many fortunes lost. Although buying strategies to offer limited risk to the trader, limited to the premium paid for the option as long as the position is not left to expire in the money, you should keep in mind that any type of options trading carries a significant risk of loss. After all, losing $500 5 times still equates to losing $2,500. Nonetheless, options buying strategies when performed and implemented correctly and with good timing may offer a fantastic risk and reward profile. In this series of articles, we explain what options are and describe several options trading strategies used for trading options by professional traders. Many of the strategies we write about are options selling strategies, but we wanted to dedicate an equally significant portion of our educational program to cater to traders who want to buy options. Your knowledge and understanding will play a major role in any successful trading experience. Of course, good luck doesn't hurt as well. And you are welcome to call or email us if you need any help at all. The logistics of buying options are simple. In fact, it is easier than putting together an IKEA desk. All the information is provided on a silver plate. See our presentation, What Are Options? All you need to do is choose an option price that matches your anticipation of the market direction and the amount you want to risk, and then place the order on your online trading platform or call your broker with the order. When you buy options, several factors come into play and influence the value of your option. Some bear more significance than others, namely volatility, time decay, the number of days left until expiration, the distance of your option from the market level. Generally speaking, the more time left to expiration, the more volatility there is. And the closer your option strike price is to the market level, the higher the value of the option is, and the better it will hold its value. Let's talk about volatility and options. One of the fundamental aspects options buyers need to put their attention on is the volatility level. In fact, as much as option sellers really trade time, it could be said that options buyers are essentially volatility traders. What is volatility, and how is it manifested in the market? Low volatility is created by an underlying market that is trading in a range-bound and subdued manner. A market with low volatility conditions is typically a flat market, though the volatility index, VIX, which measures volatility in the stock index, could be low if the market trends up consistently without corrections. High volatility, on the other hand, is created by an underlying market that is trading in a non-consistent and choppy manner. A market with high volatility conditions will typically be characterized by large moves up and down, though here too, the volatility index, VIX, could be very high if the stock market trends down strongly and consistently. While some options buyers employ options in directional trading, attempting to capture large market movements and to leverage on-market trends, other traders focus on changes in volatility as a means to potentially profit from buying and selling options. Think about it. Every underlying market constantly moves, and volatility consistently moves and changes with it. Even if you subscribe to complete randomness in the market, you would probably agree that the market goes through periods of high volatility and periods of low volatility. The effects of high volatility and low volatility on options valuation creates windows of opportunity for options traders. The reason is simple. When volatility is low, options are typically undervalued or fair valued. The reason, in a nutshell, is that when a market trades in a flat manner, the probability that it will break out, up or down, and reach options that trade away from the market level is generally small. Therefore, option sellers are willing to collect lower premiums for the risk, and options buyers are not willing to pay much for such options. For more about this point, see our presentation, What Are Options? These would be good times to purchase options. On the other hand, when volatility is high, options will tend to be overvalued. Options become overvalued in times of high volatility because of the uncertainty traders, both long and short, find themselves in. This uncertainty is born from the fact that huge and fast market moves, i.e. high volatility, may cause both calls and puts to greatly increase in value. Furthermore, traders who sell such options will demand higher premiums for their risk, and traders who buy options will be willing to pay more. Hence, when considering volatility, an options buyer's costs would be lower in times of low volatility and higher in times of high volatility for similar identical options. That is not to say one should not buy options in times of high volatility, but one should simply be aware of the pricing. If a trader is able to capture an undervalued option when volatility is low and sell that same option when volatility increases, he or she is in a good position to make profits. Let's move to our next items, which influence options valuations and options buyers. Volatility aside, the value of your option is a matrix of how far it is from the market level and the time left to expiration. In fact, the first thing to understand when you are buying options in general and when you are buying out of the money options in particular is that the value of the options is greatly influenced by time. Each and every option has an expiration date. If you buy a call or a put with 60 days to expiration, in 60 days your options will expire. If the market fails to reach the specific strike price of your option, the option will expire worthless and you will lose the premium you paid when you purchased the option. When you buy options, you are working against time. It is not the end of the world, the sky is not falling, but it is important to understand that as an option buyer, you are working against time, and it's important therefore to learn how to minimize the negative effect of time on your options. The term to remember about time in your option is the process options traders call time decay. You see, when you buy an option that is out of the money, the value of your option is comprised almost entirely of time, the time left until expiration. Every day that goes by, your option loses a small portion of its time value, even if the market moves closer to your option. Every single day, the process of time decay takes a toll on your option, and eventually, if time runs out and the market did not reach your option strike price, your option will expire with no value at all. This is the process of time decay. An important fact to remember is that as time passes and expiration nears, the process of time decay accelerates. An option with 15 days left to expiration will lose time value faster than a similar option with 30 days to expiration. And that option in turn will lose time than a similar option with 60 days or 90 days left to expiration on that option. Let's try and see how to minimize the effects of time decay. To cope with the adverse nature of time decay, options buyers could buy options out of months in time and hold the options for no more than 1 or 2 months, respectively, then replacing them with new options with a time horizon of 3 or 4 months or more. This will not eliminate the erosion of time value, but it will prevent you from entering the zone of more rapid time decay, which is 60 days and less prior to expiration. Now that we have explained some of the basic elements that influence options buyers, you can move to take a look at some options buying strategies. Here's to your success. And remember, there is substantial risk of loss in trading futures options. Remember that past performance is not necessarily indicative of future results. And remember that only risk capital should be used. Hope to see you again soon.